Hello and welcome to the i3 Insights podcast. My name is Wouter Klijn and I'm the Director of Content for the Investment Innovation Institute. As you probably know, we love our disclaimers in this industry, so here's ours. The following recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. All right, Geoff Warren, welcome to the i3 podcast.
Thanks, Wouter.
You're probably one of the few academics that I know whose work has a more practical application to the investment industry and practitioners. And to a large degree, this has to do with your background. Mm-hmm. Can you tell us a little bit about the various roles you had in your career?
Yeah, well, before sort of deciding to take the second phase of my career, which was in academia, I spent about 20 years or so in financial markets, and really I had sort of three roles that I was playing there. One, I spent some time in investment banking, specifically agency brokerage and the research departments of agents, tied to institutional broking. And there I did roles from being a stock analyst to an economist to a strategist and also a bit of time as head of research. I also spent some time with AMP Investments, as it was called in those days, as an equity portfolio manager, focusing on Australian equities with a long-term focus. And the third part of my career was with Russell Investments, where I was the Director of Capital Markets Research in Australia, and that was attached to the asset consulting function within Russell.
Yeah, so you actually have really managed money. Do you think that gives you a different perspective on some of the academic discussions that are going on?
Oh, absolutely, yes, without a doubt. I think it was very, very helpful for me to do it the way around that I did. That is, be in the markets, then become an academic. It didn't help me become a better academic, but it helped make my research more relevant, and I think that's quite important.
Yeah. So what made you switch to academia?
I like to think of it, I wanted to make a bit of a difference. So it wasn't just about earning a large salary, because I certainly took a big drop in salary to become an academic. It was more about doing something a bit more meaningful. And I've always had my eye on teaching. I like, teaching people, bringing through younger people and helping them out. And that was an opportunity to do that. And that's to continue today, where my role is a convener on the student managed fund that ANU has set up, which means that we're giving students a pot of money, real money to manage, and helping them to do that. And I find that is a fantastic teaching gig.
Yeah. So how is that going? Are they having any success?
Well, it's only just early days, and they've just made a couple of stock investments at this stage, but they've largely been in the in building their investment process, and actually I think they're learning quite a bit from it. And we don't measure performance quarterly or even yearly. They're evaluated on how well they build the legacy towards creating a better fund for the long run.
Yeah. So is the focus more on asset allocation?
It does both asset allocation and active Australian equity selection. So the portfolio is divided in two, and the equities team has a concentrated stock picking portfolio with a very, very long-term focus, and the asset allocation team has the other half of the portfolio and can use ETFs to swing the asset allocation in the fund. And we also have a risk and compliance team, a CIO, a relationship team, which is like the business development manager equivalent. So we're set up like a small funds management organisation, and it's running endowment money. So it thinks like an asset owner and thinks like an endowment fund.
Yeah, so you're really preparing them for a career in the funds management industry, so they don't actually have to learn on the spot when they get a job, but they can immediately get up to speed.
Absolutely.
Yeah.
And we're also teaching them more than just how to pick a stock that you want to buy. We're teaching them how to manage portfolios and everything that goes with it.
That actually might tie nicely into some of the research that you've done. One of the research papers focused on long-term investing. It was a topic that you've done together with the Brandeis Institute. What is long-term investing? Is it simply that you buy and hold forever, or what is really the long-term there? Is it about holding periods?
No, not necessarily. I argued in that work, and by the way, the Brandeis paper was part of a continuum of research that I did in that area, and it originally came from a collaboration with the Future Fund when I was at the Centre for International Finance and Regulation, and the Brandeis paper is a follow-on from that stream of research, and what we're arguing, the initial piece was it's really a mindset more than anything else. And the mindset has to be fixed on maximising your long-term outcome, not trying to beat the market in the short run. And I think that's the way to look at it, because what that means is it's not necessarily a buy and hold thing. Because you're a long-term investor doesn't mean you sit there and you hold something for the long term. What you do is always reevaluate in terms of how it meets your long-term objectives. Now, one of the best examples of this is something that came out from a character that some people know of called Jack Gray, who's currently at Brookvine. And he said he faced this situation himself, I think when he was at Sun Super. And that is, they had bought something that they thought was cheap and it went up massively in value, like it could have tripled. And he wanted to sell it. And he was asked, why should you sell it now if you're a long-term investor? And his answer is because, the long-term returns no longer look attractive. The price has gone up a lot. Now, there's nothing inconsistent with a long-term investor making that sale, in my opinion. It just means that, the investment you have doesn't suit your long-term objectives anymore. So it's more the mindset that decision was made through the frame of what it means for the long term, rather than just the view that we're long-term investors, we must hold forever.
Yeah. And actually, I think Jack was earlier on our podcast as well. So talked a little bit about that. So it's more a mindset. But what are sort of the key characteristics of a long-term investor? Because I looked at the paper and some of the attributes almost seemed more leaning towards behavioral finance rather than a set investment strategy.
It is to some extent behavioural. That's definitely a player. It's hard to sort of focus on the long term, and you always get distracted by the short term. So that's there. But I actually think the bigger issue is the agency problem. And this is an idea that came from David Neal, the managing director of the Future Fund. And I remember when we first sat down to talk about the project, David was in the meeting and he said, I think long-term investing is an agency problem. And it took a while for that to sink in. But where that comes up is that what the industry is designed at is a whole chain of agency relationships where the investor's delegating something to some investment organisation, the board is in charge, and then they delegate down to the internal management, and the internal management delegates down to the managers. And the problem is that you're giving somebody some funds to invest for the long run, but you have to continually monitor them and work out what they're doing. And so what are you going to monitor on if you know nothing otherwise is how they performed. And so if they perform poorly in the short run, there's two possible explanations. The long-term strategy is still okay, they're still a good manager, continue with them, or they may be a bad manager and something is wrong. And you never quite know because the future hasn't arrived, the long term hasn't arrived. So in that sort of gap between knowing what the outcome will be and having to monitor people under a agency relation, you just can't trust them for the long run. You don't have the right to do that. That's where a lot goes wrong, and that's where you see people taking their funds out when the performance isn't there, and so on. And that behaviour then encourages short-term behaviour on behalf of who's managing it, because they feel that if they don't deliver the short-term performance, then they won't have the gig anymore. So I think that's really, really crucial, and it comes from the fact that the long term is the long term, and it won't arrive for a long time. So all you've got is sort of short-term performance in the meanwhile to deal with that. So the solution to that is to try and broaden out the way that people are evaluated beyond just focusing on the short-term performance numbers, such as looking at how they behave and ask if they're investing in line with agreed objectives and pursuing the long-term diligently, and do you trust them? You know, issues like that come to the fore.
Yeah, is it possible to set sort of a guideline or a framework around that, where when these situations occur, you say, okay, in addition to performance, we have to take off some of these other topics as well?
Yes, I think the strategy is basically you need closer engagement between the principal and the agent. So let's say the asset owner and the fund manager. And so that the fund manager is explaining to the asset owner why they're making the investments, so they know what's happening. And when the performance comes out, they say, okay, it didn't work out, but we did everything we agreed. You understand why we did it. It was the right thing to do in the time. And our strategy is still on course, even though we've just had this wobble. So that closer engagement, I think, is really a crucial to that, to breaking that nexus. So you've got to not evaluate purely on the performance numbers. You don't want that the only information you've got about whether the person's doing a good job or not. You need to go deeper. I reckon the best way of distinguish a short-term and a long-term mindset is it doesn't come from me, but the idea that short-term investors are worried about price drivers and long-term investors worry about value drivers or value creation. And that sort of often leaves you down the fundamental path. You know, what's the long-term cash flows, what's the long-term returns, what's the long-term outlook. So what a short-term investor will do when they're worrying about price driver is that how over the next 3 months, what determines the return you get on any stock, for instance, is just whether the price goes up and down. So you immediately begin to think, what are the type of things that will cause that price to go up and down? Well, is the market going to revise its earnings? Is there somebody else with selling a big line of stock that'll push the price down? What news flow or rumours are in the market? Those sorts of things. When you're investing for the long term, what you're concerned about is if I buy this stock today, I may have to hold it for a long period of time, although I may not, but will it deliver value for me in the long run? What drives that value? And you start to think about, is it well managed? Can I trust the management? What investment opportunities does it have? Does it operate in a good, solid industry? And importantly, am I buying it cheap given the cash flows I think it might develop? So that's probably the best way of looking at the dichotomy. A long-term and short-term investor will focus on different things, and a long-term investor has a different mindset and a different focal point.
So is it fair to say that a short-term investor would more look at technical trends in prices rather than the underlying fundamentals of a stock?
Oh, absolutely. If it helps them predict where the price is going to go in the short term, there's nothing wrong with them looking at technicals. A lot of people would beg to differ that technicals work. That's not the point. But yes, that would definitely sit within the scope of a short-term investor.
Yeah. So does that then also mean that certain investment styles lend themselves better to long-term investors than others?
Yes, but it's interestingly not neither value or growth. It could be either. It's fundamental. So I don't think that's the distinction. The main dividing line tends to be around more momentum-orientated styles. Are they short-term or long-term? And even there you can debate whether they're inherently short-term. They do tend to be associated with short-termism, and it's largely because momentum predicts short-term price swings. But I discovered when I was working with the Future Fund, they're arguing that if momentum generates a premium because it's exploiting some behavioural errors that the market makes, and that premium is there consistently, then as a long-term investor, you'll maximise your long-term outcomes by capturing that premium.
Yes.
And so they were happy to back momentum strategies as a long-term investor. So I think it's right to say that some styles are more inherently long-term than short-term, but I'd be reluctant to actually lump this into a style bucket dimension, is what I'm really trying to say here.
Yeah, it's not as black and white that you can say value is long-term and momentum is short-term.
No, not as black and white as that.
So another topic that you looked at is probably could be related to long-term investment, and that is bringing some of the asset management functions in-house, a trend that we've seen here in Australia with a number of the large funds. But you were, when you originally looked at the issue, you were a little bit skeptical of that movement of bringing asset management in-house. Why was that?
Well, as an academic, I don't like to think I was skeptical at all. I like to think I was totally balanced and open-minded before I did the research.
And were you?
I like to think so. But the point was, I suppose, and you're getting to here, is when I came out the other end, I'd sort of leaned towards the view that in-house management was a good thing. But let me explain why, and let me highly conditional that statement. What we discovered, because this project, by the way, stepping back, was interview-based. So we went and spoke to 20 people around the industry and got their views on in-house management. And not surprisingly, funds who were doing it were quite positive on it, and there were some skeptics, and they were largely sitting around the fringes. But what you discovered when you spoke to the funds, that they were doing it in a very thoughtful manner. You didn't get the sense that it was driven by hubris at all. And there's also a number of checks that ensure that they weren't just going to sort of go out and bet the farm thinking they could do something that they couldn't do. They also, in many instances, need to justify what they're doing to the board. And the boards were sceptical, and they were asking them to justify the position they're taking and so on. So I think there was a natural check there. The other check in this system is that it's being done by people who are reasonably experienced, in the sense that, it's not just super funds who don't know what they're doing. They're employing people who have investment experience, often have been fund managers themselves in the space. So they're not ignorant people doing this. And I'd say one third thing I'd put in there is that, and this was the argument that I hadn't thought of before we went in, was that it's being done in little discrete pots. So there's this impression that big in-house management is one big bag thing, and when you do it, you're relying on everything in-house. But the funds were all doing it in different spaces. Like somebody might be doing private equity co-investment, somebody might be doing it in their equity funds, some could be doing it in an active strategy in the equity funds, some could be doing it as some sort of core strategy. And you realise that each of these little pots was actually somewhat independent. And as one of the larger fund managers put it to me, is for this to blow up the fund, it's got to go wrong in each of those little pots. And even then, in the equity proportion, they're not managing the entire equity portfolio in-house. They're managing a portion of it in conjunction with external managers. So when you sort of look at that, you say, well, where's the fund going to blow up from in-house management? Now, I said I'm going to caveat that, and I'll move on to that. I suspect that it's cautious at this stage, but I wouldn't rule it getting out of hand at some point. And one of the very large asset owners or super funds we spoke to said that when we first did this, the board was extremely sceptical and we had to justify them to them. Now I'm finding the board is pushing me to do more, and that makes me uncomfortable. So it's like that when you get comfortable and you think it's going to be successful and you see other people are getting successful, I think if we go into that stage, then you've got to start worrying, because people will start doing things they shouldn't be doing.
And that was one of the questions I put to you is, that the original phase, we've come quite a long way, and some of the funds I know manage almost a quarter of their assets in-house, which is a fairly large chunk. And are planning to expand that further as well. And it just made me think, because a couple of weeks ago, I spoke for the podcast to Rob Pruge, and he was at State Super at the time that they decided to go the other way. They had an internal model, and they decided to go external. And partly that was driven by, at the time, there was Nick Leeson, who blew up the Barings Bank. And to a degree, it only needs one person to cause a major catastrophe. And the other thing there was that they said, well, we feel that we're doubling up on risk because we have the agency risk internal as well. Do you become more worried about some of the downsides of in-house management?
Well, the points that Rob Pruge has made, I think, are valid. You need to take that into account. And I think this is all a matter of scale and scope that you're pursuing. Actually, I mentioned I used to be a broker, and State Super, as it was in those days, used to be one of my clients, and that was a 100% internally managed equity portfolio that then became Axiom, which was employed as a manager in a multi-manager structure, and then they ultimately hived it off to Deutsche Bank. So that's the history of that one. So you could readily argue that in the early stage that was too much. If it's part of a multi-manager structure, that's fine. But I also think, how are you doing it? If you try to manage a large equity fund, 100% active internally, you run into a whole lot of problems. You're totally beholden to your agency problems with that manager you have internally, and everything that goes with the fact that you own them internally. You're relying on them. It's active. It'll have capacity problems. I think that sounds like a recipe for disaster. 100% internally factor-based portfolio, core portfolio, that might be okay. But a multi-manager structure has a little bit more stability to it, I think. And you also have a benchmark for your internal manager, and that's the external manager.
Yeah, absolutely. Part of this drive to in-house management is because the funds are getting larger and larger.
Yeah.
It's no secret that there's also a regulatory push behind funds becoming larger and merging. And we were thinking about some of the other research that you have done into capacity. Scale is not great for all asset classes. It might be great for direct investments, infrastructure, but equities might be more problematic. How do you look at that issue?
I think that is definitely the case. And another one of the projects that I did when I was at CIFA was around capacity, and there was 3 papers here. And I'm going to talk about the second of those 3, which is around capacity management for asset owners. And it basically argued that capacity may differ across the different asset classes. And hence, depending on your size, you would tailor the way you invest to your size and your ability to exploit capacity or where capacity hurts you. So a small manager, a small fund, could go into, small cap equities, take concentrated strategies and so on, where capacity is not such an issue for them because of their small size. But it's very hard for them to go into unlisted property and unlisted infrastructure, for instance. They're just not a player, and nobody will want to partner with them probably. As you get larger, you change the way you invest. The type of you start to really feel capacity constraints in equity markets. You might not even bother with small cap equities. They don't move the dial for you. How you invest in large cap equities may change towards something that's a little bit more benchmark-like, with a little bit of alpha added into it, and then you start to concentrate on the unlisted markets where scale is actually beneficial. And I think that's an overarching way to look at it. It's a horses for courses issue, and there's advantages in being big and there's advantages in being small. You just have to work out which they are and then try to invest along the lines of your competitive advantage.
Yeah. In the issue of capacity, we talked a little bit earlier about different styles and how they related to long-term investing. But styles do have also a significant impact on the capacity of a fund manager.
Yeah.
Can you tell us a little bit about that?
Yes, this was really quite the interesting part of our third paper in particular, when we tried to delve into the modelling of capacity and how you worked out what the capacity is, particularly for an equity fund. And this is one of the rare instances where you do the research and stuff comes out that looks really interesting. You go, wow, I didn't expect that. And it was about how capacity emerged when you looked at different styles. And we were investigating a quant-based momentum strategy and a value fund, which is Investors Mutual Limited. They gave us their data to look at what it was. How they were, to help estimate their capacity and just help the project along. And what we realised is that most people looked at capacity through the trading lens. How quickly could you trade? how effectively can you trade? As you get larger, you can't trade so effectively, so you must hit capacity. And what we worked out is that was just far too simplistic. There's lots of drivers, and they're intimately related to style, is just the question you're asking. One of the key players is what's the time profile of your alpha. So we found with IML, they made virtually not much alpha in their first year when they bought a stock, and it all came in years 2 and 3. So for them, getting set quickly did not matter at all. The trading side was virtually irrelevant. They could take 6 months to get set and they probably still make the same return. But if you're running a momentum strategy, getting onto the stocks you want to buy quickly really matters. Okay, so trading will matter a lot there. Another thing we found was where's the source of your alpha? If you're making your alpha in small caps, you're going to have less capacity than if you're making your alpha in large caps. But it's not only where, but it's also the breadth of your opportunities. If you're running a concentrated 10 stock portfolio, or for instance, or 20 or 30 stocks, you have to, and so you're trying to exploit a limited number of opportunities, you're going to cap out quicker than somebody who's trying to take a quant-based strategy, for instance, that's spread over maybe 60, 80, 100 stocks. Very simply, if you have 20 opportunities, you're going to have the half the capacity who has somebody who has 40 opportunities. So these sort of things are intimately connected with the way that the investor invests, and hence capacity is very closely related to investment process, I think. And just trying to see it through the lens of trading, I think, is far too narrow.
Yes, and I thought one of the interesting findings as well that you have mentioned is that the capacity should probably be less seen as a hard limit, and you start seeing dilution of the earlier returns much quicker than probably people are expecting, and where they would set their limits. Yes,
I think I know what you're leading at here, and so it did say some interesting stuff came out of this research. So the way we set up our model to incorporate all these different influences, we say, all right, we set up a model and then we keep on running it until we can't invest any more dollars that generates an alpha over a certain level, let's say 2%. And when I ran the model, lo and behold, it said we can't invest any more beyond sort of so many $1 billion if you want. But yet I looked at average alpha and it was 4 or 5%. Much higher, but isn't my hurdle too? And what I realized was, hey, this is the difference between marginal and average alpha. And the model was saying, at the margin, we can't put any more dollars into this strategy and generate the return we require. But what we've already got invested happens to be earning 4 or 5% alpha. And so what I realised is that the industry, in a sense, by saying, okay, keep on investing until alpha is 0 or maybe some level, let's say 2%, is giving license to managers to keep on investing even though that marginal dollar is not earning any decent alpha. And so it does imply that capacity is actually a bit lower than the headline alpha number would suggest in the headline analysis. And we call that a sort of effective capacity at that point. That's when you get it. Now, what happens if you exceed that? It doesn't mean that you necessarily start generating negative alpha, but what it does mean if you exceed that level is you're paying active fees for something that's just adding in benchmark performance. And I think it's really, it's a really interesting way of looking at it. And I think it's somewhat at odds with the way the industry has looked at it so far.
So do you, have you spoken to any of the asset owners about these issues, and do you know how high on the agenda it is and how well they manage those capacity constraints?
Yeah, I get the impression that the industry knows it needs to deal with capacity constraints, but is struggling really with how to come to grips with it. And that was the motivation for doing this research in the first place. It didn't seem to be done properly. So I said, most of it's been trading orientated and its focus and the way people have measured capacity so far. The asset consultants often, I think, know capacity is important, but they're relying on the managers to tell them what it is. And somebody quipped to me once, the capacity of any manager is always $1 billion more than what they currently manage. That sort of cynical view. It's a little bit harder to say exactly where the where the super funds and the asset owners are on this. I don't really have. I wish I had a better insight into that. I'm bet my bottom dollar they know it's important, but I also bet that the fact that it's not being dealt with that well in the industry means they don't have as good a handle on it as well.
Would be interesting to see some more discussion on that point.
Yeah.
Your latest research looks at a different aspect again, and it looks, to a degree, I framed it in the sense of retirement and developing a comprehensive income product for retirement, a SIPR. But you look basically at probably a more academic level about different ways of constructing portfolios. And instead of using the modern portfolio theory, you look at using a utility-based approach.
Yeah.
Can you tell us a little bit about the advantages of that and also how it ties back into the bigger discussion around developing these retirement strategies?
Okay. I'll start off with two things to set the context. One is what led me to this particular idea is that I was involved in the MDUF, Members Default Utility Function initiative, started up by David Bell at Mine. And I was on the working group there. And so my work is, I view as like taking that a little to the next step and focusing particularly on which utility function you choose to drive MDUF. Okay. The second thing I'd say for context is what I believe will lead the industry into looking at utility functions is the fact that it has to develop SIPRs. Because I do not think mean variance portfolio theory does the job there. I don't think it's adequate. Largely because what you're dealing with is a complex, multi-period dynamic issue. And it's very hard to collapse that down into a mean variance framework. So mean variance might do if you're asking yourself the question of how is my portfolio going over the next year? You can work out a nice looking portfolio in terms of mean and variance, and it probably does the job okay. But if you're going to say, okay, how am I going to design an investment strategy and a withdrawal strategy for the next 30 or 40 years, and I can't see how that can be done in mean variance space. So I think utility functions are going to be integral to evaluating outcomes in when you're doing that analysis. So I think the industry is going to have to embrace utility functions, in my opinion, or find some other solution that I haven't thought of yet.
Yeah. So as a quick definition, what are utility functions? How would you best describe them?
They sound like something that you want to avoid because it's deep in the academic literature, and that's been the case. But I think the easiest way to think of it is that they're just a scoring system, and they score outcomes. And let me dwell on this a little bit. When you're doing mean variance analysis, what you're saying is I have a preference for a higher mean and avoiding variance. So what you're not doing is evaluating outcomes. You're evaluating some measure that reflects the underlying outcomes. What a utility function does is says, let's look at all the outcomes and put a score on each one and then add them up. So you can do a simulation, for instance, and get a distribution of outcomes. You can put a score on every part of that simulated distribution and add them up to say, what score do I get? And then you're basically trying to pick the one with the best score. So it's basically a scoring mechanism. And if you sort of just reduce it to say this is just a way of scoring a range of outcomes, it's the sort of technical fear might start to dissipate a little bit, I think, if you look at it through that prism.
Yeah, and I think one of the big advantages of using this approach is that you can customize it easier to individual circumstances where you can dial up one particular score or dial them down. And that is particularly relevant for the retirement space where people will have different circumstances, different account balances. And so it made me think, why hasn't this been used more widely? What is sort of stopping the uptake of this?
Well, I think the first thing is that this is not what is taught in universities. Everybody is familiar with mean variance analysis. If you go and do a finance course, that's the first thing you're taught. Modern portfolio theory, CAPM, the rest of it's all in that space. So that's what people grow up with, that's what they're familiar with. Secondly, the industry has a lot of infrastructure built around mean variance analysis. The Financial Analyst Journal or the Journal of Portfolio Management, are full of it, okay? People have committed themselves to it. A lot of what I'm discovering and talking about this, and I get the sense that a lot of asset owners out there have built their portfolio analysis structure around it, and they're not going to throw it overnight just because some academic puts their hands up and say, hey, why do you use utility? So it's a legacy issue. The third thing is that utility functions have they not only look like they're hard to implement, but people charge them with being too hard to characterize. So that I've said, how are you going to choose a utility function? Is probably the main response I've got. I don't think it's as hard as it looks, but I think that's sort of like that's something that's turning people off, is the fact that you have to go and then subjectively choose the utility function.
Yeah, because I think the original work looked basically at one utility function, and your research is looking at 4, if I'm correct. And I was talking to an investor last week, and I mentioned that you were working on this. And when I mentioned, this incorporates 4 utility functions, they almost were startled. That's way too complicated.
Yeah, I think it was 3 utility functions and 4 examples.
Right.
Okay. But that's generally it. But
yeah.
But I think that sort of looks all right. They're scared of it being overcomplicated because you're asked to do 4 things. It misses the point of what I'm saying here, and that is you're not trying to sort of say this is the right utility function and just impose it on the analysis. And then this is why I say I'm trying to develop MDUF, because it chose a particular utility function. In fact, that's what the working group was about. Which one should we use at this stage? But I think you need to turn the problem on its head. You should say, all right, let's understand that investor, understand their needs, understand their preferences. Now let's go and find a utility function that represents what they want, what their preferences are over outcomes. So the sort of thing you're doing is saying, okay, is this person concerned about the size of their balance in their superannuation fund, or are they concerned about generating a target income? And I would use one utility function if it was the former and another utility function if it's the latter. All right, let's say they're worried about target income. Next question is, how much pain do they feel if they're below their target? Is that a life-ending event for them, or does it leave them destitute, or have they got tolerance for that? So you might design the utility function accordingly. How much preference do they have for being above their target? Do they give that much credit, or do they just want to reach the target and they're happy with that? Do we shove a bequest motive on the end of that stream? You have to ask whether that's relevant. But what you do is you got to tease out what is the preference over these outcomes that this person or this institution has, because I think they can be applied to institutions or organisations, and then try to embody their objectives and preferences within a function that can be used to score those range of outcomes. That's the way to look at it. So it's turning it around. It's not saying get something out of literature and plug it in. It's saying go and design it.
Yeah, and you said it's applicable to institutions as well. And I was thinking about the issue of risk appetite. And to a degree, I think it's almost more applicable to institutions, because institutions deal with certain constraints, certain time frames. Well, when you come back to individuals and you ask them, what's your risk appetite? They probably have no idea. They just don't like to lose money. So I think it's harder to say this person is really risk-seeking and this person is really conservative, because it probably depends much more in which stage of life they are. How does that come back into the model, the risk appetite?
I'd like to think of it as implicit rather than explicit. So can I just go back to contrast with how risk appetite might be used if you were doing mean variance? You would basically say, here's mean, here's variance. What number do we put in front of the variance to penalise variance? Okay, that's your risk aversion. It implies a preference over variance, and you're trying to encapsulate it all down in this notion that I have an aversion to volatility. Okay. What happens if you go into utility functions, which are scoring outcomes, is you don't have to directly say, what is your risk tolerance? You ask what your preference over the various outcomes is. You try and encapsulate that. And so if I go back to what I was saying about the retiree who was worried about a minimum level of income in retirement, the question is, how much do you dislike being below your target? Does it leave you destitute, or is it something you can bear? It's not exactly a question or a survey about their risk tolerance. It's a question about how do they feel about various outcomes. And then you encode that in the utility function and use that to evaluate the outcomes. So I think there's a sort of like tweak there that says you're not actually trying to get another metric, risk tolerance. You're trying to encapsulate preference over outcomes.
Yeah. So looking ahead, what other research topics are you investigating?
We should have asked me this one before. I sort of counted up how many I try to do too much, and I counted up how many live projects I have on my list, and it was about 13 at the moment. So there's a lot going on there. But I am doing some more. I'm doing some work on how risk evolves with investment horizon. Doing some work on the value of imputation credits to retirees with a sight on the Labor Party potential change in policy and what that might mean. There'd be two examples. I'm trying to do a bit more work in the capacity space, specifically to see how capacity might vary across asset classes, and we've got the help of Mercer with that, where they're giving us access to some of their manager data. So there's sort of three things that are in the pipeline.
Yep, and at the same time, you're also training the next star managers for the endowment fund.
Tried to get them to do as much work as possible.
Excellent. Well, Geoff, thank you very much for your time today, and it was great working with you.
Okay, thanks, Wouter. Thanks for the opportunity.
Thank you for listening to the i3 Insights podcast. For more information, please visit our website at www.i3-invest.com. Thank you.